This morning we were focusing on the perspectives of policymakers, and on this panel now we're going to focus on what the views of the markets seem to be about the situation in Europe and about the prospects for a potential resolution of this crisis in Europe. And the three panelists that we have here, they don't not only have a great deal of market expertise, but each one of them also at some point during their career has had to deal with financial crises, sovereign debt crisis, and so on. And so let me welcome here on this panel to the right of me, Vincent Reinhart, Chief US Economist of Morgan Stanley. Next to him is Peter Fisher of BlackRock, head of BlackRock's fixed income portfolio management group and a member of the Global Executive Committee of BlackRock. And then to the very end over there, we have Staley, who is chairman of JP Morgan's Corporate and Investment Bank. Yeah? And so to frame this discussion that we're now going to have, I just want to spend 2 or 3 minutes laying out a few basic questions as a framework that I hope our panelists will be able to respond to. And then we'll have the panelists speaking for a few minutes each about their views on these questions, and then we can open it up to question and answers from the audience. Yeah? And so I basically want to pose 3 questions to the panel here, and the first one is about the recent actions by the ECB, where at the end of July, Mario Draghi basically said that the ECB is ready to do whatever it takes to keep the Eurozone together. And at least looking at the data from markets, it seems like markets have reacted quite strongly to these announcements. So as one example here, I have the 2-year yield on Spanish bonds, and you can see that they dropped from around 7% within a few weeks to levels close to 3%. And so the question now, of course, is this now really a fundamental change in the dynamics of the crisis in Europe? Or is this just yet another example of an instance where the proverbial can has been kicked one more step down the road, and maybe in a few months we'll find ourselves in the same situation as earlier this year when yields start rising again? And so I'd like to hear the panelists' views on that. My second question relates to what we discussed this morning with the policymakers panel, where it became quite clear that if you're thinking ahead about what could happen in Europe, how a path of that crisis could look like, one thing that's going to be really important is to see whether people will support these reforms that they have to go through. And if you're thinking about that question, one thing that might be important there is whether people actually see some light at the end of the tunnel. So is there some path that will eventually, after a lot of pain, lead out of that crisis? And so looking at, again, market data recently, one might think that maybe Ireland is showing us a path out and some light at the end of the tunnel. So if you look at Ireland, in Ireland, the 2-year note yield has come down within the last 9 months from levels of around 10% to something that's now below 2%. Now, one might wonder, of course, is Ireland really a role model here? Is it showing the path out of the crisis for these other countries? Or is Ireland somehow a special case where what's happening in Ireland doesn't have all that much relevance for what's going on in Spain and in Italy? And then finally, my last question is whether we should also think of this whole problem as a monetary and a monetary policy problem. Right? So in the discussion this morning, it became very clear that there are the problems in the banking system, there are the problems in labor markets and so on that these countries have to fix. But one might also wonder whether there is a monetary problem in the sense that expectations of nominal growth, not only expectations of real growth, are also going to matter a lot. For any kind of calculation about whether a country is able to serve its debt in the future, it's nominal growth that matters. And clearly, for nominal growth, expectations of very low inflation rates or even expectations of deflation are not going to be very helpful. And so I have a plot here of the break-even inflation rate of German inflation index bonds over a 5-year horizon, and you can interpret this roughly as the expected inflation rate for the Eurozone, because these inflation index bonds are based on a Eurozone price index. And so if you look at the data there, what you saw in early July looked in a way very scary, right? We had expectations of about 0.5% inflation over 5 years baked into these prices of these bonds. And you know, it may be true that the actions of the ECB also had some effect on that front. So we now see that these expected inflation rates have recovered to around 1.5%. And so I hope our panelists will be able to comment on some of these issues. And I just want to jump in and call on Jess to maybe give us his view on this in the next few minutes.
Obviously, it's been a very long 5 years for the financial markets. And I would, when I look back over it, there are two beliefs in the financial community across bankers, investors, regulators that sort of got shattered during the financial crisis. The first one was that a AAA security was cash. So much so that when Basel first met to look at bank accounting, everyone agreed that a AAA security left on a balance sheet of a bank had no risk and therefore required no capital against it. And obviously we learned a very painful lesson by that being wrong. The second belief began in January 1st of 1999 when the market got itself comfortable across the spectrum, again, bankers, investors, et cetera, that a country in the Eurozone issuing a sovereign note denominated in this brand new currency called the euro, supported by this new institution called the European Central Bank, was in fact the credit risk of the Eurozone. And for a decade, we allowed Greece to borrow at essentially the exact same interest rate as Germany. And just like AAA securities weren't cash, what the market has come to learn is that Greece is not Germany, and the Eurozone, to the extent that there is not a fiscal union, is a series of 17 independent credit risks. And the conviction, particularly on the back of Greece, is that you can in fact have a default in a sovereign issuer in the Eurozone. The challenge is, how do you put the genie back into the bottle? And is it possible, and what will it take to get the market to have a conviction that in fact the Eurozone is a single credit risk? It's immensely costly to the Eurozone that the market today does not hold that view. All you have to do is look at the borrowing costs of the US, the UK, Japan, compare that with Southern Europe, and it's very self-evident the cost of having lost the confidence of the broader marketplace. The challenge is sovereignty on the one hand and some sort of fiscal union on the other. I think our broad belief inside the bank is that ultimately the political capital which has been spent forging the Eurozone will be sufficient over a long period of time to come to some level of fiscal union such that you will be able to, broadly speaking, look at the Eurozone as a single credit. Perhaps the first instance might be what they're currently talking about, the European Union banking supervision, where you bring the banks together under one governing body. But what I would say about your charts is I think that the European Central Bank and Mario Draghi has convinced the market that there will not be a liquidity crisis. You know, pre-LTRO and pre the recent announcements, people would talk about, is there going to be a Lehman-type event in Europe? And I think the market has gotten pretty comfortable that the European Central Bank will find the means and the mechanisms in order to avoid a one-time liquidity shock that could be terribly disruptive to Europe. But you have to say, looking at not just the 2-year rates, but the 10-year rates for Southern Europe, that the market clearly is not convinced that we have eliminated default risk in Southern Europe. So there is an enormous way to go from calming the markets down vis-a-vis the liquidity risk and getting to a point where the default risk is spread across all of the Eurozone which ultimately I think has to be the goal of the political leadership in Europe.
Maybe before we go on to Peter, maybe just one more question. Just want to follow up on this. When Mario Draghi announced his new program at the end of July, one thing he was emphasizing was this convertibility risk. So that when you look at peripheral debt, you not only have the default risk and some liquidity issues, but there's also this convertibility risk. And it seems quite difficult to put a number on this, but I was just curious whether you have a view on this, or whether in-house you have somehow, managed to get your hands around that issue.
Well, the other challenge, I think, and Angela Merkel sort of touched on this in some of her comments vis-a-vis Greece, when they went through the exercise of the private sector coming to a significant discount on the private sector debt, and the public sector not following in the same course. Clearly, what it said at that instance was that bank debt was subordinate to sovereigns helping each other, which led to a real challenge we have in Spain now. Every time there's this notion that the Eurozone is going to come to the help of Spain, if in fact there is not clear pari passu treatment with the private debt holders, what you're doing is you're subordinating and making the debt positions even worse as you provide government assistance. And that's been one of the big challenges around getting economic support from Europe into the Spanish banks. There's been some $600 billion of capital outflows for those countries. As we said, I think the LTRO program has taken the liquidity risk off the table. I don't know the internal numbers well enough to talk about the convertible issue, but there is this whole issue of subordination as well, which I think is a thing that they've got to wrestle with.
Okay, then we'll turn to Peter. Given the amount of money that BlackRock is managing, maybe you have already seen Peter's views in these charts here, but I hope he can provide a bit more color.
Well, let me change roles and go back when Vince was supervising me when I was at the New York Fed in 1998, 1999. The United States was just about running a surplus. And as manager of the system open market account, I was terrified that someone was going to make me start to buy munis. And I'd already figured out that we'd have to have differential haircuts. That if we went down that path, if we ran surpluses for too long, we'd have to have a differential haircuts for different states. And I pleaded with my friends in Frankfurt to implement this as they launched the euro. And they said, no, that would be silly, we don't need to do that. And that was one of the most important original sins of the euro. The other was not integrating their banking systems, was to engineer national champions in Milan and Rome and Paris and Frankfurt, rather than taking the three big economies and trying to get the big banks to integrate. That was the second original sin of the euro. So here we are, more than a decade later. To your first question, I think that Draghi at the end of July did some extraordinary things. First, he tied himself to the mast of the euro. And investors are certainly waiting to see whether anyone else will tie themselves to the mast. If the politicians won't show the political courage, it's not clear why we should put our clients' money in harm's way. But Draghi did, and he certainly deserves a lot of credit for that. He broke the problem down, he and others, into manageable pieces. They haven't solved it yet, but in mid-July, it was still one big blob. And now we have X billion, 50, 100 billion euros for the Spanish banks, is different from the question of a banking union, is different from an eventual question of fiscal union in Europe, is different from the ECB's operations. And it's been tremendously helpful. Together with Draghi's political courage, that put 20% back into European equity markets. That's a big risk premium coming out. It's still not enough. If you look at the bond markets, there's still a huge premium in there. I prefer to call it an ignorance premium because we have a very hard time figuring out what's really going to transpire, notwithstanding how much spreads have tightened. So you can see there's a lot of uncertainty if you look at forward swaps, 2 year over 1 year versus 1 year, the 5 year over the 5 year. This is a really steep yield curve in Spain going out there. And what that tells me is there's something slightly incongruous between President Draghi and the ECB's commitment to do whatever it takes and conditionality. I understand why we have both, but from where the market sits, infinity and conditionality aren't quite the same thing. They don't sit very well together. I understand why politically that has to happen. And you can see that in the slope of the curve going out, notwithstanding inside 3 years how tight things have come in. Clearly, there's a liquidity premium of some extraordinary magnitude, an illiquidity premium in Spanish and Italian bonds. Maybe the negative nominal yields you can see in Germany is a reverse breakup premium. Some of my portfolio managers think that if you do a calculation about the probability of a Deutschmark appreciation, that would get you to negative nominal yields at the very short end, if you try to work your way through that. But clearly there's this big uncertainty, ignorance premium sitting in Spanish and Italian debt still. And it's going to be hard for the ECB to get it out while maintaining conditionality. I think that's really the dilemma. Again, I want to repeat, I understand why conditionality has to be there. I just saw President Draghi in Tokyo explain. But that's not going to solve it at the spread level in the market, and we're going to be left with this on premium. It would be marvelous if someone, the ECB or the ESM or somebody, could find a way to give us a pure vehicle for pricing convertibility risk. Because I think if we could price it separately, we would find these spreads to come in much more. That is, this ignorance problem around this, if you could somehow get a separate vehicle, complete the market by pricing that separately, we would bring in spreads a lot more. I'm afraid the Spanish banking system is expecting spreads to come in magically the day the program's announced. I don't think that's going to happen because of this ignorance, uncertainty premium that persists. Let me stop there.
Okay. Vincent?
I think it's helpful to work backwards. And if you told us all that there's something like a euro area as we know it two or 3 years from now, then 3 things had to happen. Number one, because it's a terrible currency union, it has to be a fiscal transfer union. If it's a fiscal transfer union, number 2, you need budget rules, monitoring, and enforcement. Even then, that's not enough resources given how deep the hole has been. Number 3, you'll need a pan-European issuer to lever the available resources if necessary. Moreover, now that it is both a sovereign and a banking crisis, you have to replicate that machinery for both the sovereigns and for banking institutions. That's hard. That's at the treaty level. And if you think about it, for it to be a fiscal transfer union, right now, German politicians have to be willing to write a big check. For there to be budget rules, monitoring, and enforcement, French and Spanish politicians have to give up a measure of sovereignty. For there to be a pan-European issuer, in principle, German politicians right now have to be willing to write a blank check because you don't know what the contingent claims will be. This is all very hard, and indeed, think of Peter's example of municipal securities. We've had one currency for a very long time, but we've had a lot of individual issuers. And if you accumulated those spreads, the deadweight loss associated with that must be enormous. Why? Because we can't figure out the right commitment mechanisms to make that durable. And so European officials are exactly in that situation. And then therefore, if you can't commit a government, then it could break down because of the voters. Either the voters in the core countries getting restive at the transfer of resources to keep the project going, or voters in the periphery countries getting restive at the conditionality required to get those resources. Now, at that level then, what you need is an entity that can work in a democracy deficit. That's a central bank. Essentially, the ECB right now is doing fiscal policy. Think of those 3 things you need for the euro to work. Well, fiscal transfer union, the ECB is doing right now by accepting large target 2 imbalances, which are basically contingent fiscal transfers. How about budget rules, monitoring, and enforcement? They're going to delegate that in the OMTs by requiring a country that's helped to have a memorandum of understanding with another group of bureaucrats. And number 3, pan-European issuers, when they do those OMTs, they will be buying sovereign debt and funding them by issuing deposits of the ECB, which happens to be a pan-European issuer. Now, a central bank can do fiscal policy for only a while. The ECB's great advantage in all this is that as opposed to classic currency runs, a lot of what you worry about, deposit flight, capital flight, is still internal to Europe. And as long as you're willing to do the fiscal transfers in the form of the target 2 imbalances, it holds together. The great disadvantage of the ECB is they're doing fiscal policy waiting for politicians to build the durable infrastructure with those 3 things. And if it becomes not credible, then that disadvantage could indeed ultimately erode the one advantage they have. That is, what will the ECB do when the capital flight's no longer internal?
Yeah. So you think it might have been a mistake for the ECB to take the actions it has taken, given that we saw in the past that politicians tend to only move if there's enough pressure in the markets to...
So the euro is existential to the ECB. And so that the central bank does have to act. And in some sense, they are hoping that, that their action to prevent a crisis prevents the catastrophe. Mm-hmm. And a central bank can do fiscal policy in the interim. That's the compression of Irish spreads that you show. But a central bank doing fiscal policy sets up concerns about longer term price stability. That's also consistent with the 5-year forward you're showing.
I think that's a neat way to think about the problem both the ECB and the Fed face. When everyone talks about the exit problem, it's not the exit from monetary ease. It's the exit from having become a fiscal policy agent. Mm-hmm. That's hard.
And if you're the fiscal policy agent, you can't exit the stage until someone else enters stage right. That is, the legitimate authorities who have the mandate to do fiscal policy on a sustained basis.
Yeah. Actually, on this point, some people do perceive this risk that we might go off into a scenario with very high inflation. At least some people talk about this. Do you see this in the markets? I mean, clearly, if we look at just the expectation on average, it doesn't seem to be there. But is this kind of tail risk of high inflation, is this showing up anywhere in the markets?
No, I think the chart you show on German inflation is German inflation creeping back up to where it's been over the last 10 years, but it's not there yet. The Germans had 3-4% inflation for much of the last 15 years. German economy did okay. They don't want to talk about it much, but that was their experience. So I don't think that's it. I do think there's a great fear in the market of volatility shock in the future. They don't quite know whether it's a real rate shock or an inflation shock. They just know to worry about a backup of real rates, a backup of the term structure, whether it's real or nominal. And that does drive investors, crowd them into the short end.
I think 2 of the things that the market is telling us is, one, right now there is not a conviction around inflation risk. But on the other side, I think they are also saying that the transmission of low interest rates to economic growth is also not there. So the effectiveness of what the Fed and the ECB are doing is really questioned in terms of economic growth, but that there's some bubble out there in terms of inflation expectations. You don't see it in the forward curves at all.
So I think that the dominant feature for the medium term in both the U.S. and Europe is an economies working with resource slack, real short rates staying low for a very long time. That's not an environment to worry much about the short to medium term consequences for inflation. The exit strategy, ultimately politicians coming to take the place of central banks doing fiscal policy, does create a medium or longer term risk of fiscal dominance in both places. That should be a concern. And part of the problem of not having defined, the lack of leadership is defining where we want to go in the long term, put central banks at risk.
One of the challenges I think we've all touched on is how much of a crisis do we need to find ourselves in before the political will is there to make the fiscal adjustments necessary away from what the central banks are doing. Quite frankly, one of the challenges, even when you look at the fiscal cliff here, the markets are saying right now will allow you to borrow short-term at 0 interest rates. Where's the incentive to control how much you're borrowing?
Okay, so I think it's time we open up for questions from the audience. So we have two microphones, one over here and one over there. Yeah, Lorenzo, do you want to?
Of course, when you say that central bankers do fiscal policy, they get a bit nervous. So I'm still a bit central banker, maybe less, more than you are. So I tend to see this in a different way, in the sense that it depends on whether you think that Italy and Spain are solvent or not. If they are solvent, but the markets doubt it, then what the central bank is doing is not fiscal policy, is what Poole wrote in, I don't know, 69, accommodating a portfolio shift from what markets consider as excessively risky to what is not as risky as what the market. So it's correcting what the markets is doing. Now, if we instead think that Spain and Italy are not solvent, then clearly the ECB is getting into fiscal policy, and that's very risky. So for the next crisis, to deal in a better way, for the next crisis, I agree with you that you need something centrally which is much more efficient in terms of safety net. But for the end of this crisis, hopefully, I don't think that you can solve this crisis unless you have a clear view at the political level about whether Spain and Italy are solvent. And that's why the ECB has asked for the conditionality, I think. So the ECB is asking Germany and the others, is Spain solvent? Is Italy solvent? And if you say that it is, and you're ready to put the money there, then I'm not doing fiscal policy. I'm doing accommodation of portfolio shifts. So maybe it's
So I think the answer is, as long as you're not completely sure it's solvent, then you are doing fiscal policy because you are putting the resources of the area at potential risk. In some sense, it's similar to Secretary Paulson's discussion about the GSEs in the summer of 2008, where he basically asserted it was a type 2 crisis. It was a self-fulfilling crisis that if all you had was a big enough bazooka, you could solve the problem. In retrospect, in fact, it was a first-generation crisis. It was a crisis that was fundamental to the balance sheet. And putting those funds to risk meant ultimately doing fiscal policy. So I agree completely. In some sense, the ECB doesn't have a choice. The way I describe ECB policy and Federal Reserve policy is a lot like service comedies of the 1940s and 50s. They always have this scene in which the officer comes up and says, "Men, we need a volunteer for a dangerous mission. You probably won't come back alive, but your nation will thank you if you just take 2 steps forward." And then everybody takes 2 steps backward except the hapless hero. And the hapless hero is a person you wouldn't choose for the mission, who doesn't have the tools suited to complete the mission, but winds up embarking on the mission because of the failure of everybody else. And I do think in this particular case, central bankers are the hapless heroes.
Now, I think the markets will parse it a little differently. I'm agreeing with your colloquy. But the market can't settle now on is Spain or Italy solvent in a kind of classic single actor, gee, are they going to be able to pay their bills or not? Because the question of whether they'll keep paying their bills in a currency called euros is actually a collective decision of a bunch of actors that are very elusive to us, as Greece has taught us. So the pure solvency liquidity dichotomy kind of breaks down in the morass of the collective action problem of will they be paying their bills in euros or not. And thus my ignorance premium getting baked into the forward term structure.
Hi. I was wondering if you could explain a little more why the ECB should care about the fiscal policies of its member states in the EMU. It seems to have nothing to do with monetary policy.
Former head of monetary affairs gets to take that one.
So if we could get back into the DeLorean then we could pick a point in time where back to the issue of market discipline, Greece and Spain could borrow very cheaply, basically at Greek levels, because market participants mistook a monetary union as also implying a fiscal union, and then acted accordingly, and then forced politicians to justify that belief. If they are intertwined, then the ECB does have to worry about fiscal policy because it also exposes its own balance sheet. So is it possible to have a complete separation where you could imagine a central bank conducting monetary policy and fiscal authorities conducting fiscal policy, and default being always an option, or default conversions always being an option? Then in principle, that could work, but ultimately central banks are creatures of the government, and issues of fiscal dominance. Central banks always get intertwined in bad fiscal policy. Hence, if the ECB is to be the monetary policy entity for a continent, it's got to worry about the fiscal policies of the constituents of on that continent.
Between the SMP, the EFSF, the LTRO program, the ECB's balance sheet is clearly extended and committed to Europe and to the southern periphery. So if there's not some level of fiscal discipline, and all these horrible things about the exit strategy will definitely come true.
Sorry, how do you see high rates affecting the ECB's balance sheet negatively, or their their ability, the euro itself? How do high rates contribute to the euro existing or not existing?
I mean, if you have a country that's got sovereign debt to GDP of 100%, and you've got interest rates of 5, 6, 7%, there's no way you'll get the level of economic growth to ever pay the debt down.
Put more crassly, if the central bank has lost any influence over the term structure of Spanish debt, it's lost the ability to implement monetary policy. So the term structure of interest rates should be principally determined by the expected path of monetary policy. Once the term structure of Spanish debt is completely divorced from what the ECB is doing in Frankfurt, the monetary transmission mechanism is shot. So that's the shortcut, I think, to what you're looking for.
Could one also say that, or put it this way, that the way they constructed the monetary union, Europe basically gave itself voluntarily, in a way, emerging market status for its debt, right? Where you have countries that are borrowing in currencies that are not their own, basically.
Yes, agreed.
Yeah, and so.
Sorry, I want to know whether the market participants have thought about or done studies on why there's such differential triggers with the debt to GDP ratios of the countries. Like in Russia, 18% it defaulted essentially, and then you can have Japan at 250% and various other economies within Europe at different rates, and yet we have no models or thinking about what these triggers are that causes that to happen. So I want to know if you, from anything you can see in the markets that give you indications of that, or what your own thinking is with regard to that.
There's probably been no trade that has single-handedly caused more pain on Wall Street than going against Japan and the yen. So I think people are very, on one level, bewildered about some of the raw economic data coming out of Japan versus other markets and where the real term interest rates are.
You would be better at this than me, certainly, but you have the pool of domestic savings, the current account position, and the strength of the banking system. And I would think all three of those give you those would be the three major drivers I would look at in thinking about debt to GDP deviations, if you will.
Yeah, so my wife Carmen and Ken Rogoff and Miguel Savastano identified that observation between emerging and advanced economies. They call it debt intolerance. That if you look at sovereign defaults across the world, most EM defaults occur at levels that probably would satisfy the Maastricht Treaty. So what is it that countries Some countries are debt intolerant, and it essentially relates how stable is the underlying demand for the sovereign debt. If you're like Japan and have repressed domestic savers, that therefore allows you to hold more debt. That's also been an argument that the Italian government has made, that because so much of Italian debt is held domestically, it should have a higher debt threshold. So it relates, it just maps back to just how tightly are you under the control of the pool. Can you control the pool of savings?
But if anything, the last couple of years should be a lesson to us. If you lose that market confidence, it is incredibly difficult to regain it. That's exactly what's happened to Spain and Italy.
Jeremy Bulow, I'm an economist here. So Mr. Staley mentioned how we've moved from having the market perceive there being one risk for Europe to there being maybe 17 separate risks, and I think I interpreted his remarks as saying it'd be good to move back to where there was one big risk for Europe, and I was wondering if the other folks felt that was the right goal, or whether the right goal might be to evolve to a system where there were 17 different risks for the 17 countries.
In some sense, it maps into the conversation this morning. What is the longer run vision for Europe? If currency union is in some sense a disciplining device that gets the economies more toward efficient place, that is used to foster efficiency gains and labor market reforms, and it becomes the shining city on the hill, then one currency, one risk, a united Europe is a laudable goal. On the other hand, if you don't think you're going to get there, then you probably need relative prices to help make adjustments. If not, you have to be willing to have large ongoing transfers, and so it just depends on what your long-term vision is. If you think like I do, there's still going to be 17 distinct countries and 17 distinct governments, I'd kind of like to have some relative prices to allow more efficient transfers across, rather than fiscal transfers to level that playing field.
One small challenge, if you keep it 17 distinct credit risks, is in fact the ability of the Eurozone to support its banking system. And if the banking system is one of the unfortunate pillars of efficiency that we need in a modern economy, it's sort of as if, imagine during the height of our financial crisis, if what was standing behind Bank of America wasn't the Federal Reserve or the FDIC, but rather was the state of North Carolina. I think we'd have a very different view of how you'd have to operate the U.S. banking system.
Well, we were there in just the late 1980s with banking crises in Ohio and Maryland, and the S&L crisis of the 80s was very regionalized, concentrated in some states and not in others. I think it is a political economy question. It doesn't seem likely to me, but it does to some Europeans, that they're going to go straight to a fiscal union negotiated in Brussels, and how much we pay the bus drivers in Lisbon is going to be set by some bureaucrat in Brussels. I just can't see us getting there. I think it's going to have to evolve, forgive me, much more as the American fiscal union did, on an a la carte basis. Look at all the different ways the federal and state governments interact in the United States. Who manages Medicare? Who manages Social Security? Who does the dam work, but it's subsidized by the federal government? The transportation expenditures flow back, and it ends up being a la carte. And the place to begin is with an FDIC for Europe because of the importance of banking union. But you end up with 18 credits at the end of the day, not 17 and not 1.
Are there any models that where the central bank and the government are not part of the same nation state, other than the case of Eurozone, which still seems like an experiment? Because I remember we treated US government debt as a risk-free investment just because the Federal Reserve could buy the debt at any time in unlimited amounts. So if Spain or Italy, the question that Lorenzo asked, are sovereigns without the ability of their own central bank buying their debt, how is this model sustainable? And just talking about the model itself as an abstract structure, given that the independence of central banks is a recent economic development. They were not always independent.
The answer to that is no.
No,
but no, there isn't an example of a central bank.
So this is a unique case.
No, except 1914 to 1933 or 4 or 5, depending on how you want to count. Because the level of federal indebtedness just wasn't that high. We had an exchange rate mechanism between the states going on back and forth across a gold standard. And so it was a much more idiosyncratic banking system, if you will. It was not a unified national banking system. We prohibited banking across state lines. The federal government wasn't a big fiscal transfer union in 1914, even though we did have a war on and some debt accumulated from that, but then it came down again. So there's some aspects you can look at of the early Federal Reserve that is worth thinking about, and the Europeans did when they were setting up the ECB. Oddly, the designers of the Federal Reserve System expected different monetary policies in each of the 12 districts because the banking systems of each of the 12 districts were going to be different. They didn't quite anticipate that reserves were tradable at par, and therefore it was going to be one national monetary policy, actually. So that's the only example I know of.
But absent that, when you have then one central bank and 17 different sovereign nations, how do you reconcile that?
Well, any emerging market economy that issues debt denominated in somebody else's currency has broken the link between the fiscal authority and the monetary authority. In the European context, it is 17 issuers with an imperfect link between the fiscal authority and the monetary authority, and that's exactly what the very awkward position the ECB officials are in now with national governments. And I think the answer is it no doubt involves a lot of improvisation.
So we have time for one more question, and then unfortunately we'll have to stop.
I'm Nata Dmati from Stanford Business School. And one of the things that was kind of skirted around, but very related to the initial comment about how we learned about AAA, is that we learned also about sovereign debt from Greece. Dexia fell on assets that are sovereign related after passing a stress test based on risk-weighted assets. And so the one flaw in this system is this political problem, is the zero risk weights on sovereign European bonds, which didn't come up yet, but it's highly related to painful lessons that are not learned, which is in this system where the link is broken, we still pretend that things with yields reflecting risk are actually as good as cash, and encouraging banks to invest in those things so that banks and governments can fail at the same time.
Well, I tried to address that by talking about the failure of the ECB to apply differential haircuts when they lend against national. If I thought the zero risk weight was the worst thing in Basel II, maybe we would have brought it up. But there's so many terrible things in the Basel process and the risk weighting, we would take a whole hour on that.
And I think it goes back to the discussion, aren't you better off with 16 relative prices than none? And the answer is yes, and that includes the pricing of collateral.
Your question opens up a whole other field that we could go into, but for sure, I think one of the responses to the financial crisis is deep concern by regulators about the financial industry's involvement in maturity transformation. And perhaps at the end of the day, what might have an even greater impact on this point about carrying sovereign debt on bank balance sheets will be the whole calculation of liquidity and issues around the LCR coming out of Basel. But as currently discussed, there's an enormous incentive for the banking community to carry sovereign debt on its balance sheet as a way to meet its liquidity requirements. And is that a third leg that we're walking into with our eyes closed?
Okay, then let me thank the panelists very much for participating here today and giving us their insights. Thank you. Yep.